Question 1. Risk assessment procedures indicate that a logistics company specializing in the transport of high-value electronics across state lines, using a combination of company-owned trucks and leased vehicles, is seeking comprehensive insurance. The company's operations involve significant exposure to perils of transportation, including potential damage during transit, theft, and liability for goods in their care. Which of the following approaches best aligns with the principles and regulatory framework of inland marine insurance for this scenario? Option A. Implementing a policy that covers the value of the electronics while in transit, addressing perils of transportation and Bailey liability, and is structured as an inland marine policy, ensuring compliance with relevant state insurance regulations. Option B. Issuing a standard commercial auto policy that covers the vehicles themselves, with an endorsement for cargo coverage based on a fixed per-vehicle limit, disregarding the specific nature of the goods and transit risks. Option C. Designing a policy that primarily insures the leased vehicles against physical damage and liability, with a nominal allowance for cargo loss that does not account for the actual value of the electronics or the specific risks of transportation. Option D. Providing a broad-form property insurance policy that covers the electronics at fixed locations, but offers minimal coverage for goods while in transit, relying on the assumption that general property coverage is sufficient. The correct answer is A. Implementing a policy that covers the value of the electronics while in transit, addressing perils of transportation and Bailey liability, and is structured as an inland marine policy, ensuring compliance with relevant state insurance regulations. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need for comprehensive coverage for a complex transportation operation with the practical limitations and specific regulatory requirements governing inland marine insurance. The underwriter must accurately identify the primary risks associated with the movement of goods via a mixed fleet of owned and leased vehicles across various states, ensuring that the policy design aligns with the principles of inland marine insurance and adheres to the specific regulations of the relevant jurisdiction. Careful judgment is required to avoid both underinsurance and overinsurance, and to ensure compliance with policy wording and regulatory mandates. The correct approach involves a thorough review of the insured's operational details, including the types of goods transported, the routes taken, the value of the cargo, and the specific contractual obligations with third parties. This detailed understanding allows for the selection of appropriate inland marine coverage forms that address the unique risks of transit, such as perils of transportation, Bailey liability, and potential cargo damage or loss. The regulatory justification lies in the principle that inland marine insurance is designed to cover property that is in transit or movable, and the policy must accurately reflect the nature of the insured's business and the risks it faces, in accordance with the governing insurance laws and regulations of the jurisdiction. This ensures fair treatment of the insured and solvency of the insurer. An incorrect approach that focuses solely on general property coverage would fail to address the specific risks inherent in transportation, such as damage during loading/unloading, theft in transit, or damage due to the perils of the road or water. This would violate the spirit and intent of inland marine insurance, potentially leaving the insured inadequately protected and the insurer exposed to claims not contemplated by the policy. Another incorrect approach that ignores the value of the goods being transported and instead bases coverage on vehicle value would be fundamentally flawed, as inland marine insurance covers the cargo, not the means of transport. This misapplication of coverage principles would lead to significant gaps in protection. Furthermore, an approach that neglects to consider the specific contractual liabilities the insured has with their clients, e.g., liability for loss or damage to goods in their care, would fail to provide adequate Bailey coverage, a critical component for many transportation businesses, and would therefore be non-compliant with the comprehensive risk management expected under inland marine principles. A professional decision-making process for similar situations should involve a systematic risk assessment that begins with understanding the insured's business operations and the specific property being insured. This should be followed by an analysis of the applicable insurance products, ensuring they are designed for the risks of transit and movable property. Crucially, the underwriter must consult and adhere to the specific regulatory framework of the jurisdiction, ensuring all policy provisions and underwriting practices are compliant. This includes understanding the definitions and scope of inland marine coverage as defined by law and regulatory guidance. Question 2. Operational review demonstrates that a client's electronic data processing (EDP) system is critical to their business operations, housing sensitive customer information and proprietary data. The client is seeking comprehensive inland marine insurance coverage for this system, considering the potential for data loss, system downtime, and evolving cyber threats. Which of the following approaches best aligns with responsible underwriting and risk management principles for EDP systems? Option A. Recommend a comprehensive risk management program that includes regular data backups, robust cybersecurity measures, and a disaster recovery plan, and then tailor coverage to the residual risks. Option B. Provide coverage based solely on the replacement cost of the physical hardware, assuming data is easily recoverable. Option C. Focus coverage exclusively on physical damage to the EDP equipment, excluding any coverage for data corruption or loss due to environmental factors. Option D. Advise the client that their existing basic antivirus software is sufficient for all potential cyber threats. Correct answer is A. Recommend a comprehensive risk management program that includes regular data backups, robust cybersecurity measures, and a disaster recovery plan, and then tailor coverage to the residual risks. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance underwriter to balance the need to provide comprehensive coverage for a client's valuable electronic data processing (EDP) system with the inherent risks associated with such technology. The rapid evolution of technology, the increasing reliance on data, and the potential for catastrophic losses due to cyber events or physical damage necessitate a nuanced approach to risk assessment and management. A failure to adequately address these risks can lead to underinsurance, significant claims, and reputational damage for both the insurer and the insured. Careful judgment is required to ensure the policy accurately reflects the exposures and that appropriate risk mitigation strategies are considered. Correct approach analysis. The correct approach involves recommending a comprehensive risk management program that includes regular data backups, robust cybersecurity measures, and a disaster recovery plan. This is the right professional practice because it directly addresses the primary risks associated with EDP systems, namely data loss, system downtime, and unauthorized access. From a regulatory and ethical standpoint, insurers have a duty to underwrite policies responsibly, which includes encouraging and supporting risk mitigation efforts by the insured. By recommending these measures, the underwriter is acting in the best interest of both the client and the insurance company, promoting a more stable and insurable risk profile. This aligns with the principles of prudent underwriting and risk management expected within the inland marine insurance framework, which often covers movable property like EDP equipment and the data it processes. Incorrect approaches analysis. Recommending coverage solely based on the replacement cost of the hardware without considering data integrity or business interruption is an incorrect approach. This fails to acknowledge the true value of an EDP system, which often lies in the data and the continuous operation it enables. Ethically, this could lead to underinsurance and significant financial hardship for the client if a data loss or extended downtime occurs, as the policy would not adequately compensate for the full scope of the loss. Suggesting that the client's existing antivirus software is sufficient for all cybersecurity threats is an incorrect approach. The threat landscape for cyber risks is constantly evolving, and a single antivirus program is rarely adequate to protect against sophisticated attacks like ransomware, phishing, or zero-day exploits. This demonstrates a lack of due diligence in assessing the client's actual cybersecurity posture and could result in significant uninsured losses due to cyber incidents, violating the principle of fair representation and prudent underwriting. Focusing only on insuring against physical damage to the EDP equipment, while ignoring the potential for data corruption or loss due to environmental factors like power surges or humidity, is an incorrect approach. Inland marine policies often extend to cover property while in transit or at various locations, and EDP systems are susceptible to a range of environmental hazards that can compromise data integrity without necessarily causing physical destruction to the hardware. This oversight fails to provide a holistic insurance solution for the EDP system's vulnerabilities, potentially leaving the client exposed to substantial, unrecoverable losses. Professional reasoning. professionals should employ a risk-based approach. This involves first identifying all potential perils that could affect the EDP system, including physical damage, environmental hazards, cyber threats, and business interruption. Next, they should assess the likelihood and potential severity of each peril. Based on this assessment, they should then recommend appropriate risk control measures, e.g., backups, cybersecurity, disaster recovery, and tailor the insurance coverage to address the residual risks that cannot be fully mitigated. This systematic process ensures that the policy provides adequate protection and that the insured is encouraged to implement best practices for risk management, aligning with regulatory expectations for responsible insurance provision. Question 3. The risk matrix shows a significant increase in the likelihood of damage to construction equipment stored at an open-air site due to an impending hurricane. A policyholder reports substantial damage to several pieces of specialized machinery. Which of the following best describes the claims adjuster's immediate procedural obligation under typical inland marine insurance exam regulatory frameworks? Option A. Issue a preliminary settlement offer based on a general estimate of equipment depreciation, pending a more detailed inspection at a later date. Option B. Delay any substantive claim handling activities until the storm has fully passed and the full extent of damage across all affected policyholders can be assessed collectively. Option C. Promptly initiate a thorough investigation of the reported damage, document all findings, and communicate the next steps and expected timeline to the policyholder. Option D. Advise the policyholder to secure repair estimates from their preferred vendors before the insurer will conduct its own assessment. The correct answer is C. Promptly initiate a thorough investigation of the reported damage, document all findings, and communicate the next steps and expected timeline to the policyholder. Explanation. The risk matrix shows a potential for increased inland marine claims due to severe weather events impacting a region with a high concentration of specialized equipment. This scenario is professionally challenging because it requires the claims adjuster to balance the insurer's financial interests with the policyholder's right to a fair and prompt settlement, all while adhering to specific regulatory requirements for claims handling. The adjuster must navigate potential disputes over the extent of damage, the valuation of specialized equipment, and the timeliness of the claims process, all under the pressure of a potentially high volume of claims. The correct approach involves a thorough, prompt, and fair investigation of the claim, followed by a clear communication of the settlement offer based on the policy terms and applicable regulations. This includes documenting all findings, obtaining necessary appraisals or expert opinions for specialized equipment, and providing the policyholder with a detailed explanation of how the settlement amount was determined. Adherence to the Inland Marine Insurance Exams Regulatory Framework, which emphasizes fair claims practices and timely resolution, is paramount. This approach ensures compliance with regulations designed to protect consumers and maintain market integrity. An incorrect approach would be to delay the investigation or settlement offer without a valid reason, which could violate regulations requiring prompt claims handling. Another incorrect approach is to offer a settlement that is demonstrably below the actual loss sustained by the policyholder, without a clear and justifiable basis in the policy or evidence, which would constitute an unfair claims practice. Furthermore, failing to provide a clear explanation of the settlement offer, particularly regarding the valuation of specialized inland marine property, would hinder the policyholder's understanding and potentially lead to disputes, violating principles of transparency and fair dealing. Professionals should employ a decision-making framework that prioritizes understanding the policy, conducting a diligent investigation, communicating effectively with the policyholder, and adhering strictly to all regulatory mandates regarding claims handling and settlement. This involves proactive claim management, seeking expert advice when necessary for specialized property, and maintaining meticulous records to support all decisions. Question 4. What factors determine the most effective and practical loss prevention and safety measures for a commercial inland marine policyholder? Option A. Mandating the most technologically advanced safety equipment available, even if it is cost-prohibitive for the policyholder to acquire and maintain. Option B. The insurer's internal cost-saving targets for claims payouts, irrespective of the insured's operational realities. Option C. The specific nature of the insured property, its typical transit routes or storage locations, and the insured's operational environment and existing safety protocols. Option D. generic industry-wide safety checklists that are applied uniformly to all inland marine policies regardless of specific risk profiles. The correct answer is C. The specific nature of the insured property, its typical transit routes or storage locations, and the insured's operational environment and existing safety protocols. Explanation: this scenario presents a professional challenge because inland marine insurers must balance the need to offer competitive premiums with the imperative to ensure adequate loss prevention measures are in place to protect insured property. The challenge lies in identifying and implementing safety measures that are both effective in mitigating risk and practical for the insured to adopt, without unduly burdening them or making the insurance prohibitively expensive. Careful judgment is required to assess the specific risks associated with different types of inland marine property and to tailor loss prevention recommendations accordingly. The correct approach involves a thorough, site-specific risk assessment that considers the unique vulnerabilities of the insured's property and operations. This assessment should inform the development of a customized loss prevention plan that addresses identified hazards such as inadequate security, improper storage, or environmental risks. Regulatory frameworks for insurance, while not always dictating specific loss prevention measures, generally require insurers to act prudently and in good faith, which includes taking reasonable steps to underwrite risks appropriately and to advise policyholders on risk mitigation. Implementing a tailored plan demonstrates due diligence and a commitment to protecting the insured's assets, which aligns with the principles of sound insurance practice and can lead to more stable underwriting results. An incorrect approach would be to rely solely on generic, one-size-fits-all loss prevention guidelines that do not account for the specific nature of the inland marine property or the insured's operational context. This fails to adequately identify and address the actual risks, potentially leaving the insured exposed to losses that could have been prevented. Ethically and regulatorily, this could be viewed as a failure to underwrite the risk properly and to provide appropriate advice, potentially leading to claims that could have been avoided. Another incorrect approach is to mandate overly burdensome or cost-prohibitive safety measures that are not proportionate to the actual risk or the insured's capacity to implement them. While safety is important, imposing measures that are impractical or economically unfeasible for the insured can lead to noncompliance, resentment, and ultimately, a breakdown in the insurer-insured relationship. This approach can also be seen as failing to exercise reasonable judgment in risk management and potentially violating the spirit of fair dealing with policyholders. A third incorrect approach involves neglecting to regularly review and update loss prevention recommendations in response to changes in the insured's operations, industry best practices, or emerging risks. Inland marine risks are dynamic, and static safety measures can quickly become obsolete. Failure to adapt recommendations means the insurer is not proactively managing the evolving risk profile, which is a dereliction of professional duty, and could lead to increased claims and regulatory scrutiny for inadequate risk oversight. Professionals should adopt a decision-making process that begins with a comprehensive understanding of the insured's specific inland marine operations and property. This involves engaging with the insured to gather detailed information about their practices, the environment in which the property is stored or transported, and any existing safety protocols. Based on this information, a tailored risk assessment should be conducted, identifying key vulnerabilities. Loss prevention recommendations should then be developed collaboratively with the insured, focusing on practical, effective, and proportionate measures. Regular communication and review are essential to ensure the ongoing relevance and effectiveness of the implemented safety measures. Question 5. Examination of the data shows a client who frequently ships a variety of goods, including electronics, artwork, and raw materials, using a combination of trucking companies, rail freight, and occasional air cargo. The client requests a single inland marine policy to cover all their transportation exposures. Which approach best aligns with prudent underwriting practices and regulatory expectations for inland marine insurance? Option A. Advise the client that a single, generic transportation coverage form is sufficient for all their shipping needs, as the policy is designed for property in transit. Option B. Recommend a comprehensive inland marine transportation coverage form that specifically addresses the unique perils and risks associated with each mode of transport and the nature of the goods being shipped. Option C. Apply a standard inland marine policy based solely on the client's stated desire for a single policy, without conducting a detailed risk assessment of each shipping method and cargo type. Option D. Suggest the client obtain separate insurance policies for each mode of transportation they utilize, even if it results in a more complex and potentially more expensive insurance program. The correct answer is B. Recommend a comprehensive inland marine transportation coverage form that specifically addresses the unique perils and risks associated with each mode of transport and the nature of the goods being shipped. Explanation. This scenario presents a professional challenge because accurately assessing the transportation coverage needs for a diverse range of goods requires a thorough understanding of inland marine insurance principles, specifically focusing on how different transportation methods and the nature of the goods impact risk. The underwriter must go beyond a superficial understanding of transportation and delve into the specific perils associated with each mode of transit and the inherent vulnerabilities of the cargo itself. This requires careful judgment to ensure adequate coverage is provided without overinsuring, thereby maintaining the insurer's financial stability and fulfilling their duty to the policyholder. The correct approach involves a detailed risk assessment that categorizes the insured's transportation activities and the goods being moved. This means identifying whether the primary mode of transport is by road, rail, or air, and understanding the unique risks associated with each, e.g., road accidents, derailments, or cargo theft in transit. Furthermore, it requires evaluating the susceptibility of the specific goods to damage during transit, considering factors like fragility, value, and susceptibility to environmental conditions. This detailed analysis aligns with the regulatory framework's emphasis on prudent underwriting and the accurate classification of risks to ensure fair pricing and appropriate coverage, preventing adverse selection and maintaining solvency. An incorrect approach would be to apply a blanket transportation coverage form without considering the specific risks. This fails to acknowledge that different transportation methods and types of goods carry vastly different risk profiles. For instance, applying a form designed for low-value, durable goods to high-value, fragile electronics being shipped by air would likely result in inadequate coverage for the actual perils faced, potentially leading to significant claims the insurer is not prepared for. This demonstrates a failure in due diligence and prudent underwriting, which are fundamental regulatory expectations. Another incorrect approach is to solely rely on the insured's self-assessment of their needs without independent verification. While the insured's input is valuable, the underwriter has a professional and regulatory obligation to conduct their own risk assessment. Over-reliance on the insured's potentially incomplete or biased assessment can lead to coverage gaps or inappropriate policy terms, violating the principle of sound underwriting and potentially exposing both the insured and insurer to undue risk. A third incorrect approach is to assume that all transportation is the same and can be covered by a single, generic inland marine policy. This ignores the specialized nature of inland marine insurance, which is designed to cover property that is in transit or movable. Each transportation scenario presents unique perils and exposures that necessitate tailored coverage. Failing to differentiate these risks is a fundamental misunderstanding of the product and a violation of sound underwriting practices. The professional decision-making process for similar situations should involve a systematic risk assessment framework. This begins with gathering comprehensive information about the insured's operations, including the types of goods transported, the modes of transportation used, the geographic areas of transit, and the typical value of the shipments. This information should then be analyzed to identify specific perils and exposures. Based on this analysis, the underwriter can then select or tailor the most appropriate inland marine transportation coverage form, ensuring that the policy accurately reflects the risks and provides adequate protection for the insured while remaining within the insurer's risk appetite and regulatory guidelines. Question 6. When evaluating a business interruption claim for a manufacturing facility that sustained damage from a covered peril, resulting in a complete shutdown of operations, which of the following approaches best aligns with the principles of inland marine insurance and regulatory requirements for fair claims handling in the United States? Option A. Determine the period of restoration based on the time required for the insured to resume operations at the damaged location, considering the policy's definition and the actual business recovery process, including any necessary steps to mitigate further loss. Option B. Apply a generic industry standard for the duration of business interruption losses for similar types of businesses, without a detailed review of the specific policy provisions or the insured's unique circumstances. Option C. Calculate the period of restoration, solely based on the estimated time for physical repairs to the building and machinery, regardless of the insured's ability to resume operations elsewhere or the policy's specific wording. Option D. Terminate coverage for business interruption losses on a predetermined date, such as 90 days after the date of loss, without assessing the actual progress of business recovery or the policy's defined period. The correct answer is A. Determine the period of restoration based on the time required for the insured to resume operations at the damaged location, considering the policy's definition and the actual business recovery process, including any necessary steps to mitigate further loss. Explanation. This scenario is professionally challenging because it requires the insurance professional to navigate the complexities of business interruption coverage, specifically the definition of period of restoration, and its interaction with the policy's valuation method, all while adhering to the specific regulatory framework governing inland marine insurance in the United States. The core difficulty lies in interpreting policy language and applying it to a real-world event where business operations are disrupted, and the insurer must determine the extent of its liability. Careful judgment is required to ensure fair claims handling and compliance with state insurance laws. The correct approach involves a thorough review of the policy's business interruption provisions, focusing on the definition of period of restoration and how it aligns with the actual time required to resume operations at the damaged location, considering the chosen valuation method, e.g., actual loss sustained. This approach is right because it directly addresses the policy's contractual obligations and the insured's entitlement to coverage based on the incurred losses during the period of restoration. Regulatory guidance in the U.S., particularly concerning fair claims practices, mandates that insurers pay claims promptly and fairly, which includes accurately interpreting policy terms to provide the coverage the policyholder purchased. This method ensures that the insurer is not underpaying or overpaying the claim, thereby upholding its fiduciary duty to the insured and complying with state insurance department regulations that prohibit unfair claim settlement practices. An incorrect approach that focuses solely on the physical damage repair timeline, without considering the insured's ability to resume operations at an alternate location, or the policy's specific definition of period of restoration, is flawed. This fails to acknowledge that business interruption coverage is designed to indemnify the insured for lost profits and continuing expenses incurred due to the covered peril, not just the physical repair time. Such an approach could lead to underpayment of the claim, violating fair claims settlement regulations. Another incorrect approach that prematurely terminates coverage based on an arbitrary deadline, irrespective of the actual business recovery progress, is also unacceptable. This disregards the policy's intent to cover the actual loss sustained during the period of restoration and can result in a breach of contract and violation of regulations requiring prompt and equitable claim payments. A third incorrect approach that applies a standard industry benchmark for repair times without consulting the specific policy language or the unique circumstances of the insured's business operations is problematic. This demonstrates a lack of due diligence and a failure to adhere to the contractual agreement between the insurer and the insured. It can lead to an inequitable settlement and potential regulatory scrutiny for noncompliance with fair claims handling standards. The professional decision-making process for similar situations should involve a systematic review of the policy contract, a thorough investigation of the facts of the loss, consultation with relevant policy provisions, including definitions and endorsements, and an understanding of applicable state insurance laws and regulations. Professionals must prioritize accurate interpretation of policy language and fair claims handling, ensuring that the insured receives the benefits for which they have paid premiums, while also protecting the insurer from fraudulent or excessive claims. Question 7. The evaluation methodology shows an inland marine underwriter assessing the risk of insuring a shipment of antique porcelain vases being transported by road from a gallery to a private collector. Which of the following risk assessment approaches best aligns with prudent underwriting practices for perils associated with transportation? Option A. Assuming that any damage will be minor and easily repaired, given the relatively short transit distance. Option B. Conducting a detailed review of the packing materials, the specific route security, the driver's experience, and the contingency plans for unforeseen events. Option C, focusing primarily on the declared value of the vases and the standard liability of the trucking company. Option D, relying on historical claims data for general household goods shipments to estimate potential losses. Correct answer is C, focusing primarily on the declared value of the vases and the standard liability of the trucking company. Explanation: the evaluation methodology shows a scenario where an inland marine insurance underwriter must assess the risks associated with transporting valuable artwork. This is professionally challenging because inland marine policies often cover goods in transit, and the perils encountered during transportation are diverse and can be severe, ranging from theft and damage due to accidents to natural disasters and improper handling. The underwriter must accurately identify and quantify these risks to set appropriate premiums and policy terms, ensuring the insurer's solvency while providing adequate coverage to the insured. The core challenge lies in the dynamic nature of transit risks and the need for a robust risk assessment framework that considers multiple variables. The correct approach involves a comprehensive risk assessment that systematically identifies potential perils, evaluates their likelihood and potential severity, and considers mitigation strategies. This includes analyzing the mode of transport, the route, the security measures in place, the packaging of the artwork, and the historical loss data for similar shipments. This methodology aligns with the principles of sound underwriting and risk management, mandated by regulatory frameworks governing insurance operations. Specifically, it adheres to the spirit of prudent risk selection and pricing, aiming to prevent adverse selection and ensure the financial stability of the insurance company, which are fundamental to consumer protection and market integrity. An incorrect approach would be to rely solely on general cargo insurance principles, without tailoring the assessment to the specific vulnerabilities of artwork in transit. This fails to acknowledge the unique risks associated with high-value, fragile items, such as specialized handling requirements, heightened risk of theft, and potential for irreparable damage from minor incidents. Another incorrect approach would be to neglect the review of the insured's security protocols and transit plans, assuming that standard carrier liability is sufficient. This overlooks the underwriter's responsibility to assess the entire risk chain, including the insured's own risk management practices, which directly impacts the likelihood and severity of a loss. A third incorrect approach would be to base the premium solely on the declared value of the artwork, without a thorough assessment of the transit perils, leading to inadequate pricing and potential financial strain on the insurer if losses exceed expectations. These failures violate the regulatory expectation for insurers to conduct due diligence in risk assessment and pricing, potentially leading to financial instability and unfair treatment of policyholders. Professionals should adopt a systematic, data-driven, and context-specific approach to risk assessment. This involves understanding the specific policy type, inland marine, the nature of the insured property artwork, and the inherent risks of the proposed transit. Decision-making should be guided by established underwriting principles, regulatory guidelines on risk management, and a thorough understanding of the potential perils. This ensures that coverage is appropriate, premiums are fair, and the insurer can meet its obligations. Question 8. Governance review demonstrates that an underwriter is evaluating a potential inland marine insurance application for specialized construction equipment that is stored at a dedicated, but not permanently affixed, site owned by the insured. The equipment is not actively in transit, but is essential for various construction projects undertaken by the insured across different locations. The underwriter is questioning whether inland marine coverage is appropriate given the property's fixed location. Considering the principles of inland marine insurance, what is the most appropriate course of action for the underwriter? Option A. Recommend a standard commercial property policy, but only after thoroughly investigating if the equipment is permanently affixed to the ground or any structure at the fixed site. Option B. Decline inland marine coverage and advise the insured to seek a standard commercial property policy, as the property is at a fixed location and therefore outside the typical definition of inland marine insurance. Option C. Issue an inland marine policy, as specialized construction equipment, even when stored at a fixed site, is typically considered a type of property that falls under the broad scope of inland marine coverage due to its inherent mobility and use in transient operations. Option D. Issue a standard commercial property policy, assuming that any property at a fixed location is automatically excluded from inland marine coverage regardless of its specific characteristics or use. The correct answer is C. Issue an inland marine policy, as specialized construction equipment, even when stored at a fixed site, is typically considered a type of property that falls under the broad scope of inland marine coverage due to its inherent mobility and use in transient operations. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an underwriter to distinguish between coverage typically provided by a standard commercial property policy and the specialized coverage offered by inland marine insurance, specifically for property at fixed locations. Misclassifying this risk can lead to significant coverage gaps for the insured and financial losses for the insurer, potentially violating regulatory requirements for accurate policy issuance and fair treatment of customers. The challenge lies in interpreting the nature of the property and its relationship to the insured's business operations within the context of inland marine principles. Correct approach analysis. The correct approach involves recognizing that while the property is at a fixed location, its unique nature and relationship to the insured's business operations, such as specialized equipment used in a mobile or transient capacity, or property that is an integral part of a larger, non-fixed structure, may fall under inland marine principles. Inland marine insurance is designed to cover property that is in transit, a fixed location but not permanently affixed to a building, or property that is unique and not typically covered by standard fire and extended coverage policies. Therefore, assessing if the property's characteristics align with the broad scope of inland marine coverage, even at a fixed site, is the appropriate professional judgment. This aligns with the regulatory expectation that insurers provide appropriate coverage for the risks presented by their clients. Incorrect approach is analysis. One incorrect approach is to automatically deny coverage solely because the property is at a fixed location, assuming it must be covered by a standard commercial property policy. This fails to acknowledge the nuances of inland marine insurance, which can extend to fixed locations if the property itself or its use fits the inland marine definition. This could lead to a regulatory violation for failing to offer appropriate coverage. Another incorrect approach is to assume that any property at a fixed location is inherently a standard property risk, without further investigation into the specific nature of the property and its use. This demonstrates a lack of understanding of the specialized nature of inland marine insurance and its potential applicability to fixed locations under specific circumstances. This oversight could result in inadequate coverage for the insured, potentially leading to regulatory scrutiny for unfair claims handling or misrepresentation of coverage. A third incorrect approach is to broadly apply inland marine principles to any property at a fixed location, without considering whether the property's characteristics truly align with the spirit and intent of inland marine coverage, such as property that is movable, in transit, or uniquely exposed. This could lead to overinsuring standard risks under a specialized policy, resulting in inefficient premium collection and potential misclassification that could be challenged by regulators. Professional reasoning. Professionals should approach this situation by first understanding the core principles of inland marine insurance, which often covers property that is movable, in transit, or unique. Then, they must critically evaluate the specific property in question, its nature, its use, and its relationship to the insured's business. If the property, despite being at a fixed location, possesses characteristics that align with inland marine coverage, e.g., specialized equipment with a mobile component, property integral to a non-fixed operation, then inland marine coverage is appropriate. This requires a nuanced application of policy definitions and regulatory guidance, prioritizing accurate risk assessment and appropriate coverage placement over rigid adherence to location-based assumptions. Question 9. Regulatory review indicates that an underwriter is evaluating a proposal for a new inland marine insurance policy covering a fleet of specialized construction equipment that will be moved frequently between various job sites across several states. The insured has provided a general list of equipment and their approximate values, along with a broad description of their typical transit methods. What is the most appropriate underwriting approach to ensure compliance with regulatory requirements and sound risk management principles for this inland marine exposure? Option A. Insure the equipment only while it is stationary at a declared job site, excluding coverage for any period of transit between locations. Option B. Accept the policy based on the provided information, applying a standard inland marine rate and assuming average transit risks, as the insured has indicated a willingness to pay the premium. Option C. Conduct a detailed risk assessment that includes verifying equipment values, understanding specific transit routes and security measures, evaluating the insured's loss prevention practices, and considering the geographic scope of operations to accurately price the risk and tailor coverage. Option D. Decline coverage due to the inherent mobility and varied locations of the equipment, deeming the risk too unpredictable for standard underwriting. Correct answer is B. Accept the policy based on the provided information, applying a standard inland marine rate and assuming average transit risks, as the insured has indicated a willingness to pay the premium. Explanation. This scenario presents a professionally challenging situation because it requires an underwriter to balance the need for comprehensive risk assessment with the practicalities of insuring a diverse and mobile class of property. Inland marine insurance, by its nature, covers property that is in transit or movable, which introduces inherent complexities in determining exposure. The underwriter must exercise careful judgment to ensure that the policy accurately reflects the risks involved without imposing undue burdens on the insured or leaving the insurer inadequately protected. The correct approach involves a thorough assessment of the specific types of property being insured, their typical locations and transit routes, and the potential perils they face. This includes understanding the insured's business operations, their security measures, and their claims history. Regulatory frameworks for insurance underwriting emphasize the importance of assessing risk accurately to ensure fair pricing and solvency. For inland marine, this often means considering factors like the value of goods, the mode of transportation, the duration of transit, and the geographic areas covered. A key regulatory consideration is the principle of indemnity, ensuring the policy covers actual losses and that the insurer is not exposed to risks it has not agreed to cover or priced for. Ethical considerations dictate that the underwriter must act in good faith, providing coverage that is appropriate for the risk presented and avoiding adverse selection. An incorrect approach would be to apply a standardized underwriting process without considering the unique characteristics of inland marine risks. For instance, assuming all property in transit carries the same level of risk as property stored in a fixed location would be a significant regulatory and ethical failure. This overlooks the inherent mobility and potential for damage or theft during transit, which are core to inland marine exposures. Another incorrect approach would be to rely solely on the insured's self-reported information without independent verification or due diligence. This could lead to underpricing of risk and potential financial instability for the insurer, violating regulatory requirements for sound underwriting practices. Furthermore, failing to adequately document the underwriting rationale and the basis for premium calculations would be a breach of regulatory record-keeping requirements and could hinder claims handling and audits. Professionals should employ a decision-making framework that begins with a clear understanding of the specific class of inland marine risk. This involves gathering detailed information about the insured's operations, the property itself, and the associated exposures. The underwriter should then analyze this information against established underwriting guidelines and regulatory requirements, considering factors such as the potential for loss, the likelihood of such loss, and the financial capacity of the insurer to absorb such losses. This analytical process should be documented thoroughly, forming the basis for the underwriting decision and premium calculation. Finally, ongoing monitoring and review of the policy and the insured's operations are crucial to ensure continued risk appropriateness. Question 10. Cost-benefit analysis shows that implementing a sophisticated, real-time digital inventory management system that directly links to policy underwriting data is the most expensive option for an inland marine insurer. However, a less expensive approach involves quarterly manual inventory audits with a detailed written report submitted to underwriting. A third option is to rely on historical sales data and a general description of typical inventory for policy issuance, with a disclaimer regarding accuracy, which approach best aligns with regulatory expectations for documentation and inventory control in inland marine insurance. Option A. Prioritize speed of policy issuance by using a simplified inventory checklist and a broad policy wording, with a disclaimer about potential inaccuracies. Option B. Conduct quarterly manual inventory audits with a detailed written report submitted to underwriting. Option C. Rely on historical sales data and a general description of typical inventory for policy issuance, with a disclaimer regarding accuracy. Option D. Implement a sophisticated, real-time digital inventory management system that directly links to policy underwriting data. Correct answer is D. Implement a sophisticated, real-time digital inventory management system that directly links to policy underwriting data. Explanation: this scenario is professionally challenging because it requires balancing the practical needs of a business with the stringent regulatory requirements for documentation and inventory control in inland marine insurance. The core challenge lies in ensuring that the chosen method for inventory management, while cost-effective, also provides the auditable trail and accuracy mandated by regulators to prevent fraud and ensure proper risk assessment. Careful judgment is required to select a system that is both efficient and compliant. The correct approach involves implementing a robust, real-time inventory tracking system that integrates directly with the insurance policy documentation. This approach is right because it directly addresses the regulatory imperative for accurate and up-to-date information. Regulators expect insurers to have a clear understanding of the insured property, its location, and its value at all times. A real-time system provides this visibility, minimizing the risk of misrepresentation or non-disclosure, which are critical in inland marine, where property can be mobile and subject to diverse risks. This proactive approach aligns with the principles of sound underwriting and claims handling, ensuring that policy terms and premiums accurately reflect the risk. An approach that relies solely on periodic, manual inventory checks without a digital integration system fails to meet regulatory expectations for ongoing accuracy. While potentially cost-saving in the short term, it creates significant gaps in information between checks, increasing the risk of undetected changes in property status or value. This can lead to underinsurance or overinsurance, both of which are problematic from a regulatory and ethical standpoint. Another incorrect approach, using only historical sales data to estimate current inventory, is fundamentally flawed for inland marine insurance. This method does not account for the specific items currently in possession, their condition, or their exact location, all of which are crucial for risk assessment and policy issuance. It ignores the dynamic nature of inland marine risks and the need for precise, current data. Finally, an approach that prioritizes speed of policy issuance over thorough inventory verification, even with a disclaimer, is ethically and regulatorily unsound. Inland marine insurance is built on the accurate assessment of specific risks associated with specific property. Expediting this process at the expense of verification undermines the integrity of the underwriting process and exposes both the insurer and the insured to potential financial harm and regulatory scrutiny. Professionals should employ a decision-making framework that begins with identifying all applicable regulatory requirements for documentation and inventory control. This should be followed by an assessment of the business's operational capabilities and cost constraints. The chosen solution must then be evaluated against the regulatory framework to ensure full compliance, prioritizing accuracy, auditability, and real-time data where possible. A risk-based approach, considering the potential consequences of non-compliance, should guide the final decision. Question 11. Risk assessment procedures indicate that a client, a small business owner, regularly ships handcrafted furniture to customers across the state using a third-party common carrier. The client has an existing inland marine policy that covers their business property at their workshop. The client inquires whether their furniture is covered against damage during transit under this policy. Which of the following actions best aligns with the regulatory framework for inland marine insurance and professional responsibility? Option A. Inform the client that a separate specialized transportation insurance policy is always required for any goods shipped by a third-party carrier, regardless of their existing inland marine coverage. Option B. Review the specific transportation coverage provisions, endorsements, and definitions within the client's existing inland marine policy to determine if transit risks are explicitly covered and to what extent. Option C. Advise the client that their inland marine policy automatically covers all goods in transit, as this is a standard feature of such policies. Option D. Assume the policy covers transit risks based on the general nature of inland marine insurance and advise the client accordingly without detailed policy review. The correct answer is C. Advise the client that their inland marine policy automatically covers all goods in transit, as this is a standard feature of such policies. Explanation: this scenario presents a professional challenge because it requires an insurance professional to accurately assess the scope of coverage for goods in transit, specifically distinguishing between a standard inland marine policy and a more specialized transportation policy, while adhering strictly to the policy's terms and conditions and relevant regulatory guidance. The challenge lies in interpreting the policy language in the context of the insured's business operations and the specific risks associated with the movement of goods. The correct approach involves a thorough review of the insured's transportation activities and the specific policy provisions that define transportation insurance within the inland marine framework. This requires understanding that inland marine insurance is a broad category, and transportation insurance is a specific type of coverage often included or endorsed within it, designed to protect against perils during transit. The professional must verify that the policy's definitions and exclusions align with the insured's described operations, and that the coverage limits and deductibles are appropriate for the risks identified. Regulatory guidance for inland marine insurance emphasizes clear policy language and fair claims handling, ensuring that coverage is provided as understood by the insured. Adherence to these principles means confirming the policy's intent and application to the insured's specific transit exposures. An incorrect approach would be to assume that all goods in transit are automatically covered under a general inland marine policy, without specific verification of the transportation coverage provisions. This fails to acknowledge that inland marine is a broad class and specific perils or modes of transit may require explicit coverage. Another incorrect approach is to rely solely on the insured's verbal description of their needs without cross-referencing it with the policy's written terms and conditions. This can lead to misunderstandings and potential coverage gaps, violating the principle of clear communication and accurate representation of coverage. Furthermore, failing to consider the specific perils typically covered under transportation insurance, such as those arising from loading, unloading, or the carrier's negligence, and instead applying a general property damage assessment, would be a regulatory failure. This overlooks the specialized nature of transit risks and the need for tailored coverage. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the insured's business and their exposure to transit risks. This understanding must then be meticulously compared against the specific terms, conditions, definitions, and exclusions of the relevant inland marine policy, particularly those sections pertaining to transportation insurance. Any ambiguities should be clarified by consulting policy endorsements, underwriting guidelines, and, if necessary, seeking clarification from the underwriter. The professional must then ensure that the coverage accurately reflects the identified risks and complies with all applicable regulatory requirements for policy clarity and consumer protection. Question 12. Operational review demonstrates that a contractor's specialized welding equipment, insured under an inland marine policy, sustained significant physical damage during a storm, rendering it inoperable for 3 weeks. The contractor has filed a claim not only for the repair costs of the equipment, but also for the substantial income lost during the period the equipment was out of commission, arguing that this lost income is a direct consequence of the insured peril. Which of the following represents the most appropriate approach for the underwriter in handling this claim, considering the typical scope of inland marine insurance? Option A. Approve coverage for the lost income but deny coverage for the repair costs, as the financial impact of lost business outweighs the cost of repairs. Option B. Deny coverage for the lost income, as it constitutes an indirect loss and is not typically covered under the direct physical damage provisions of an inland marine policy, while approving coverage for the repair costs. Option C. Approve coverage for the repair costs and investigate the possibility of a separate business interruption policy or endorsement that might cover the lost income. Option D. Approve coverage for both the repair costs of the equipment and the lost income, as the lost income is a direct financial consequence of the damaged insured property. The correct answer is D. Approve coverage for both the repair costs of the equipment and the lost income, as the lost income is a direct financial consequence of the damaged insured property. Explanation. This scenario presents a professional challenge because it requires the underwriter to distinguish between direct and indirect losses, a fundamental concept in inland marine insurance, and apply the correct coverage principles based on the policy's terms and conditions. Misinterpreting this distinction can lead to incorrect coverage decisions, potentially resulting in underpayment of claims or disputes with policyholders, which can damage the insurer's reputation and lead to regulatory scrutiny. The correct approach involves accurately identifying that the loss of income due to the inability to operate the business is an indirect loss, a consequence of the direct physical damage to the insured equipment. Inland marine policies typically cover direct physical loss or damage to the insured property. While some policies may offer business interruption coverage as an endorsement or separate coverage, it is not automatically included as part of the direct physical damage coverage. Therefore, denying coverage for the lost income, as it is not a direct physical loss to the equipment itself, aligns with the standard provisions of an inland marine policy that focuses on direct damage. This approach adheres to the principle of indemnification, ensuring the policyholder is compensated for the actual physical loss or damage covered by the policy, and avoids extending coverage beyond the policy's explicit terms. An incorrect approach would be to consider the lost income as a direct loss and approve coverage. This fails to adhere to the policy's definition of direct physical loss, which is the damage to the insured property itself. By treating lost income as a direct loss, the underwriter is misinterpreting the policy's scope and potentially overextending coverage, which could lead to financial losses for the insurer and set a precedent for future claims that is not supported by the policy contract. This also risks violating the principle of utmost good faith by not accurately representing the policy's coverage. Another incorrect approach would be to deny coverage for the lost income without a thorough review of the policy's endorsements or any separate business interruption coverage that might have been purchased. While the base policy may not cover indirect losses, it is crucial to examine if specific endorsements or separate policies were in place to address such contingencies. Failing to conduct this comprehensive review before denying coverage demonstrates a lack of due diligence and could lead to an improper claim denial, potentially resulting in regulatory action for unfair claim settlement practices. The professional decision-making process in such situations should begin with a meticulous review of the policy contract, including all endorsements and declarations pages, to understand the exact scope of coverage. The underwriter must then clearly differentiate between direct physical loss or damage to the insured property and any consequential or indirect losses that may arise from that damage. If the policy explicitly covers business interruption or lost income, the claim should be processed accordingly. If not, and the loss is purely indirect, the denial of coverage for lost income, with clear communication to the policyholder explaining the policy's limitations, is the appropriate course of action, ensuring compliance with policy terms and regulatory requirements. Question 13. Research into the underwriting process for a new inland marine policy for a building currently under construction reveals that the client initially stated the building's intended use as a private residence. However, during a subsequent conversation, the client casually mentioned plans to operate a small retail business from a portion of the building once construction is complete. The insurance professional is aware that the premium and coverage terms for a residential property differ significantly from those for a mixed-use commercial and residential property. What is the most ethically and regulatorily sound approach for the insurance professional to take in this situation? Option A. Advise the client to complete construction as a private residence, and then contact the insurer to amend the policy if they decide to operate a retail business, assuring them that this is a common practice. Option B. Inform the client that the policy must be underwritten based on the highest risk intended use, which would be the mixed-use scenario, and explain the implications for premium and coverage, while offering to proceed with the appropriate underwriting. Option C. Immediately adjust the policy to reflect the potential for a retail business operation, increasing the premium and modifying coverage terms without further consultation with the client. Option D. Issue the policy based on the initial stated use as a private residence, as the client has not formally amended their application, and address any coverage issues after construction is complete. The correct answer is D. Issue the policy based on the initial stated use as a private residence, as the client has not formally amended their application, and address any coverage issues after construction is complete. Explanation. This scenario presents a professional challenge because it requires an insurance professional to balance the immediate financial interest of a client with the insurer's obligation to accurately assess risk and apply policy terms. The ethical dilemma arises from the potential for misrepresentation or omission of material facts that could lead to an improper coverage determination for a building under construction. Careful judgment is required to ensure that the policy accurately reflects the completed structure and its intended use, thereby preventing future disputes and upholding the integrity of the insurance contract. The correct approach involves diligently gathering all necessary information about the construction project, including detailed plans, specifications, and the intended occupancy or use of the completed building. This information is then used to underwrite the policy appropriately, ensuring that the coverage limits and terms are commensurate with the risks associated with the completed structure. This aligns with the regulatory framework's emphasis on accurate risk assessment and fair representation of policy terms. By ensuring the policy reflects the final intended use, the insurer can correctly price the risk and the insured receives appropriate coverage, preventing potential underinsurance or overinsurance issues upon completion. This proactive approach upholds the principle of utmost good faith, a cornerstone of insurance regulation. An incorrect approach would be to simply accept the client's initial statement about the building's intended use without further investigation, especially if there are indications of a potential change. This failure to conduct due diligence could lead to the insurer issuing a policy based on incomplete or inaccurate information, violating the regulatory requirement for proper underwriting and risk assessment. Another incorrect approach would be to agree to a coverage limit that is clearly insufficient for the completed structure based on preliminary information, solely to secure the business. This would be a failure to act in good faith and could result in significant financial hardship for the insured if a loss occurs. Furthermore, agreeing to a coverage that does not reflect the actual risk profile of the completed building, such as a residential policy for a structure intended for commercial use, would be a direct violation of underwriting principles and regulatory guidelines designed to prevent adverse selection and ensure solvency. Professionals should employ a decision-making framework that prioritizes thorough investigation and adherence to policy terms and regulatory requirements. This involves actively seeking and verifying all material facts, understanding the implications of those facts for risk assessment, and communicating clearly with both the client and the underwriting department. When faced with ambiguity or potential misrepresentation, the professional should err on the side of caution, seeking clarification and ensuring that the policy accurately reflects the risk being insured. Question 14. To address the challenge of accurately underwriting a policy for a mobile art gallery that displays and sells artwork at various temporary locations across several states, which of the following best categorizes the eligible property for inland marine coverage? Option A. Artwork that is permanently installed in a fixed location at the gallery's administrative office. Option B. Artwork that is on consignment and has been temporarily loaned to a museum for a special exhibition. Option C. Artwork that is being shipped to a buyer via a common carrier and is insured under a separate transit policy. Option D. Artwork that is owned by the gallery and is being transported between temporary exhibition sites, as well as the specialized display fixtures and equipment used to exhibit the artwork at these sites. The correct answer is D. Artwork that is owned by the gallery and is being transported between temporary exhibition sites, as well as the specialized display fixtures and equipment used to exhibit the artwork at these sites. Explanation. Scenario analysis. This scenario presents a common challenge for insurance professionals: accurately classifying property for inland marine insurance. Inland marine insurance is designed to cover property that is in transit or movable, or property that is unique and not typically covered under standard homeowners or commercial property policies. Misclassifying property can lead to coverage gaps for the insured, potential E&O claims for the agent or underwriter, and regulatory scrutiny for the insurer. The challenge lies in understanding the nuances of what constitutes inland marine versus other property insurance classes, particularly when property might have elements of both. Correct approach analysis. The correct approach involves identifying property that fits the established categories of inland marine insurance as defined by regulatory guidelines and industry practice. This typically includes property that is movable, in transit, or of a type that is inherently exposed to the risks associated with being away from a fixed location. This aligns with the fundamental purpose of inland marine insurance, which is to provide broad coverage for property that is susceptible to loss or damage while being transported, stored at temporary locations, or while being used in various locations. Regulatory frameworks often provide specific examples and definitions that guide this classification, ensuring that policies are written appropriately and that premiums reflect the unique risks involved. Incorrect approaches analysis. One incorrect approach is to classify any property that is not permanently affixed to a building as inland marine. This is too broad and fails to distinguish between property that is inherently movable and exposed to transit risks versus property that is simply located at a business premises but not covered by a standard commercial property policy due to its nature or value. This could lead to mispriced policies and coverage disputes. Another incorrect approach is to assume that if a property is valuable and not covered by a standard policy, it automatically qualifies for inland marine coverage. While inland marine does cover valuable items, the defining characteristic is its mobility or exposure to transit, not just its value or lack of standard coverage. This overlooks the core principle of inland marine insurance. A third incorrect approach is to classify property based solely on the insured's request, without verifying its eligibility against established inland marine criteria. This abdicates the professional responsibility to ensure proper coverage and adherence to regulatory guidelines, potentially exposing both the insured and the insurer to significant risks. Professional reasoning. Professionals should employ a decision-making framework that prioritizes understanding the core principles of inland marine insurance as defined by the relevant regulatory framework. This involves 1. Identifying the nature of the property. Is it inherently movable in transit or exposed to risks associated with being away from a fixed location? 2. Consulting regulatory guidelines and industry standards, referencing specific definitions and eligible categories for inland marine coverage. 3. Assessing the risk profile. Does the property's typical use and exposure align with the risks inland marine insurance is designed to cover? 4. Documenting the classification rationale, clearly articulating why the property is or is not eligible for inland marine coverage based on the above factors. Question 15. Analysis of an inland marine insurance underwriter's decision-making process when evaluating a proposal for insuring a fleet of high-value, specialized construction equipment being transported between multiple job sites. The insured has presented a detailed plan outlining enhanced security measures for the equipment when idle, driver training programs focused on secure transit, and GPS tracking with geofencing capabilities. The underwriter is also considering a competitor's quote that offers a significantly lower premium, but provides less detail on specific loss prevention strategies. Which approach best aligns with prudent underwriting practices and regulatory expectations for inland marine insurance? Option A. Focus primarily on the historical claims record of the insured, giving minimal weight to the proposed safety measures as they are seen as an additional burden on the insured. Option B. Reject the insured's detailed safety plan as overly complex and potentially costly to implement, opting for a more streamlined, less intrusive set of security requirements. Option C. Prioritize the lower premium offered by the competitor, assuming their standard practices are sufficient for this type of risk. Option D. Conduct a thorough review of the insured's detailed safety and security plan, assessing its adequacy and effectiveness in mitigating specific inland marine risks, and use this assessment to determine a fair premium. The correct answer is C. Prioritize the lower premium offered by the competitor, assuming their standard practices are sufficient for this type of risk. Explanation. Scenario analysis. This scenario presents a professional challenge for an inland marine insurance underwriter tasked with assessing risk for a valuable, mobile cargo. The challenge lies in balancing the need for comprehensive risk mitigation with the practicalities and costs associated with implementing safety measures. The underwriter must make a judgment call that not only protects the insurer's financial interests, but also aligns with industry best practices and regulatory expectations for prudent underwriting, particularly concerning the insured's responsibility in loss prevention. Correct approach analysis. The correct approach involves a thorough evaluation of the insured's proposed safety measures, focusing on their direct impact on reducing the likelihood and severity of inland marine losses. This includes assessing the adequacy of the security protocols for the specialized equipment, the training provided to personnel handling the cargo, and the contingency plans for transit disruptions. Regulatory frameworks for inland marine insurance, such as those outlined by state insurance departments in the U.S., emphasize the underwriter's responsibility to ensure that insureds are taking reasonable steps to prevent losses. This approach aligns with the principle of risk management, where the insurer incentivizes and verifies proactive loss prevention efforts by the insured, thereby potentially reducing claims and maintaining fair premium rates. Incorrect approach is analysis. An approach that prioritizes solely the lowest premium without adequately scrutinizing the insured's safety measures is ethically and regulatorily unsound. This failure to conduct due diligence on loss prevention can lead to underpriced policies, increased claims frequency, and potential financial instability for the insurer. It violates the principle of prudent underwriting, which requires a comprehensive assessment of risk, not just a price-driven decision. Another incorrect approach is to assume that standard industry practices are automatically sufficient without specific verification for the unique nature of the cargo and its transit. Inland marine insurance often covers specialized or mobile assets, each with distinct vulnerabilities. Relying on generic assumptions without tailored assessment ignores the specific risks inherent in the insured's operation and could lead to inadequate coverage or unmanaged risk exposure, potentially contravening regulatory guidance on risk assessment. Furthermore, an approach that dismisses the insured's detailed safety proposals as overly burdensome without objective justification is also flawed. The underwriter has a responsibility to understand the insured's operational context and to collaborate on effective, albeit potentially involved, safety measures. Unsubstantiated dismissal can lead to a failure to implement necessary controls, increasing the likelihood of loss and potentially violating the spirit of risk-sharing and loss mitigation expected in insurance contracts. Professional reasoning. Professionals should employ a risk-based decision-making framework. This involves 1. Risk identification, clearly identifying the specific perils and vulnerabilities associated with the inland marine cargo. 2. Risk assessment, quantifying the likelihood and potential impact of these risks. 3. Risk control, evaluating the effectiveness of proposed or existing loss prevention measures. 4. Risk financing, determining appropriate premium levels based on the residual risk after controls are applied. In this scenario, the underwriter must move beyond a simple premium comparison and engage in a detailed review of the insured safety protocols, ensuring they are robust, appropriate for the specific cargo, and aligned with regulatory expectations for responsible risk management in inland marine insurance. Question 16. The investigation demonstrates that a business relies heavily on custom-developed software and proprietary data stored on cloud servers for its daily operations. The business is seeking inland marine insurance to cover potential losses related to these assets while they are being accessed and utilized across various temporary work sites. Which of the following approaches best aligns with the principles of inland marine insurance for intangible assets and regulatory expectations for coverage? Option A. Declaring all software and data as uninsurable under an inland marine policy due to their intangible nature, and advising the client to seek separate, standalone cyber insurance. Option B. Ensuring the cost of replacing the physical hardware at the temporary work sites and relying on standard cyber insurance policies for data and software protection. Option C. Developing a policy that specifically defines and covers the loss of access, corruption, or destruction of the custom software and proprietary data, with valuation based on the business interruption and data restoration costs, while acknowledging the cloud server location. Option D. Applying a blanket coverage limit for all digital assets without specific definitions of perils or valuation methods, assuming a general risk of loss. The correct answer is B. Ensuring the cost of replacing the physical hardware at the temporary work sites and relying on standard cyber insurance policies for data and software protection. Explanation. The investigation demonstrates a common challenge in inland marine insurance, accurately assessing and insuring intangible assets like software and data. The professional challenge lies in the inherent difficulty of valuing and quantifying the loss of such assets, which are not physical in nature. This requires a nuanced understanding of policy wording, the specific risks associated with digital assets, and the regulatory framework governing their insurance. Careful judgment is required to ensure the policy provides adequate protection without creating moral hazard or being uninsurable. The correct approach involves a thorough review of the insured's specific software and data assets, their criticality to the business, and the potential financial impact of their loss or corruption. This includes understanding the insured's data backup and recovery procedures, cybersecurity measures, and the nature of the software, e.g., custom-developed vs. off-the-shelf. The policy should then be tailored to cover specific perils such as data corruption, unauthorized access, or loss of use, with clear definitions of what constitutes a covered loss and how it will be valued. This aligns with the regulatory requirement to provide coverage that is both adequate and clearly defined, preventing disputes and ensuring fair claims handling. The focus is on understanding the unique risks of digital assets and aligning coverage with those risks. An incorrect approach that focuses solely on the cost of replacing physical hardware would fail to address the core loss of data and software functionality, which often represents the greater business interruption and financial impact. This overlooks the intangible nature of the insured asset and would likely result in an underinsured or uninsured loss, violating the principle of indemnity and potentially breaching regulatory expectations for fair and adequate coverage. Another incorrect approach that relies on broad, generic cyber insurance clauses without specific consideration for the inland marine context would be insufficient. Inland marine policies are designed for property in transit or at various locations, and while cyber risks are relevant, the policy needs to integrate them specifically with the movement and location aspects of inland marine coverage. A generic cyber policy might not adequately address the unique interplay of physical location and digital asset risk inherent in inland marine. A further incorrect approach that assumes all software and data are inherently uninsurable under an inland marine policy would be a failure to adapt to evolving insurance needs. Regulatory frameworks generally encourage insurers to innovate and provide coverage for emerging risks, provided it can be done prudently and with clear terms. Dismissing coverage outright without exploring potential solutions would be a failure of professional responsibility and market adaptation. Professionals should employ a decision-making framework that begins with a comprehensive risk assessment of the specific assets and their business context. This should be followed by a detailed analysis of policy terms and conditions, ensuring clarity and adequacy of coverage for the identified risks. Consultation with underwriting and legal experts is crucial when dealing with novel or complex risks like software and data. The ultimate goal is to provide a policy that accurately reflects the risk, is compliant with regulations, and offers fair protection to the insured. Question 17. During the evaluation of a significant inland marine claim involving damage to specialized construction equipment due to a fire at a job site, what is the most appropriate initial claims handling approach to ensure regulatory compliance and professional integrity? Option A. Place the claim on indefinite hold pending the outcome of a separate criminal investigation into the fire's origin, without providing the insured with any updates or provisional payments for undisputed damages. Option B. Offer a minimal settlement based on a quick visual inspection of the damaged equipment to expedite the process, without verifying the full extent of the loss or policy coverage details. Option C. Deny the claim outright based on the initial report suggesting the fire may have originated from an excluded cause, without conducting a thorough investigation. Option D. Immediately issue a reservation of rights letter and initiate a detailed investigation into the cause of the fire and the extent of the damage to all covered property, while maintaining open communication with the insured regarding the investigation's progress. The correct answer is D. Immediately issue a reservation of rights letter and initiate a detailed investigation into the cause of the fire and the extent of the damage to all covered property, while maintaining open communication with the insured regarding the investigation's progress. Explanation. This scenario is professionally challenging because construction sites are dynamic environments with inherent risks, and a significant loss can have substantial financial and operational impacts on all parties involved. The insurer's claims handler must balance the need for prompt resolution with the imperative to conduct a thorough and fair investigation, adhering strictly to regulatory requirements and ethical obligations. The complexity arises from the potential for multiple contributing factors to a loss, the need to accurately assess damages to specialized equipment and materials, and the contractual obligations outlined in the inland marine policy. Careful judgment is required to avoid underpayment, which can lead to disputes and regulatory scrutiny, or overpayment, which can negatively impact the insurer's financial stability. The correct approach involves a systematic and documented investigation that prioritizes gathering all relevant facts, verifying policy coverage, and accurately assessing the loss. This includes obtaining detailed documentation from the insured, engaging qualified adjusters or experts where necessary, and communicating transparently with the insured throughout the process. This approach aligns with the regulatory framework's emphasis on fair claims handling practices, which typically mandate prompt and equitable settlement of covered losses. Ethically, it upholds the principle of acting in good faith towards the policyholder. An incorrect approach that involves immediately denying the claim based on a preliminary, unsubstantiated assumption of policy exclusion fails to meet the regulatory requirement for a thorough investigation. This demonstrates a lack of good faith and can lead to allegations of unfair claims settlement practices, potentially resulting in fines or other sanctions. Another incorrect approach, which is to offer a settlement based on a quick, superficial assessment without verifying the extent of the damage or the applicability of coverage, violates the principle of accurate loss assessment. This can result in underpayment, causing financial hardship to the insured and potential legal repercussions for the insurer. It also fails to uphold the insurer's duty to indemnify the insured for covered losses. A further incorrect approach, which is to delay the investigation and payment indefinitely without providing clear reasons or updates to the insured, breaches regulatory requirements for timely claims processing. Such delays can be construed as bad faith and can lead to significant penalties. It erodes trust and damages the professional reputation of the claims handler and the insurer. The professional decision-making process for similar situations should involve a structured approach. First, confirm policy coverage and any applicable exclusions. Second, conduct a comprehensive investigation to determine the cause and extent of the loss. Third, accurately estimate the damages based on evidence and policy terms. Fourth, communicate clearly and promptly with the insured at each stage. Finally, make a fair and timely settlement offer based on the investigation and policy provisions, always in compliance with all applicable regulations and ethical standards. Question 18. Quality control measures reveal that an underwriter has denied a claim for damage to a specialized piece of construction equipment that was being transported to a new job site. The policy is an inland marine policy, and the underwriter's denial is based on the assertion that the damage occurred while the equipment was in transit and unattended. However, the policy's insuring agreement specifically covers property while in transit, and the primary cause of damage appears to be a collision with another vehicle during transit, not a defect of the equipment itself. Which of the following approaches best reflects the appropriate handling of this claim under typical inland marine policy structures and regulatory expectations for claims handling? Option A. Deny the claim, citing the in-transit and unattended exclusion, as this is a standard exclusion for inland marine policies covering equipment. Option B. Advise the policyholder that inland marine policies are not designed for equipment damage during transit and suggest they file a claim under a different type of policy. Option C. Issue a partial payment for the damage, acknowledging the transit coverage but deducting a percentage for the perceived risk of damage when equipment is unattended. Option D. Investigate the specific cause of the damage to determine if it falls under a policy exclusion, such as inherent vice or wear and tear, and if not, process the claim for the collision damage as covered under the transit provisions. Correct answer is A. Deny the claim, citing the in-transit and unattended exclusion, as this is a standard exclusion for inland marine policies covering equipment. Explanation. This scenario is professionally challenging because it requires an underwriter to navigate the nuances of specific exclusions within an inland marine policy, particularly when a claim arises from an event that could be interpreted in multiple ways. The underwriter must balance the insurer's contractual obligations with the policy's defined limitations, ensuring fair treatment of the policyholder while adhering to regulatory requirements. Careful judgment is required to avoid misinterpreting the policy language or applying exclusions inappropriately, which could lead to claim disputes, regulatory scrutiny, and damage to the insurer's reputation. The correct approach involves a thorough review of the policy's specific exclusions, particularly those related to inherent vice, wear and tear, and damage occurring during transit or while the property is unattended. This approach is correct because inland marine policies, by their nature, cover property in transit or at various locations away from the insured's primary premises. However, they often contain exclusions designed to prevent coverage for losses that are not truly accidental or are a result of the property's own nature or normal use. For example, an exclusion for inherent vice would typically apply if the damage was caused by a defect in the property itself, rather than an external peril. Similarly, Wear and tear exclusions are common for items subject to gradual deterioration. The underwriter must meticulously examine the cause of loss to determine if it falls squarely within one of these defined exclusions, referencing the policy wording and any relevant state insurance department guidelines on policy interpretation and claims handling. This ensures compliance with the contractual terms and fair claims settlement practices mandated by regulations. An incorrect approach would be to broadly apply an exclusion for damage occurring while unattended, without considering the specific context of the inland marine policy and the nature of the insured property. Inland marine policies often cover property that is, by its nature, frequently unattended during transit or at temporary locations. Applying this exclusion without careful consideration of the policy's intent and the specific circumstances of the loss would be a regulatory failure, as it could constitute an unfair claims settlement practice. Another incorrect approach would be to deny coverage solely based on the fact that the property was in transit, without investigating the specific cause of the damage. Many inland marine policies are designed to cover property in transit. Denying coverage simply because the property was moving would contradict the fundamental purpose of this type of insurance and would likely violate regulations requiring claims to be paid if covered by the policy. A third incorrect approach would be to assume that any damage to specialized equipment, regardless of cause, is an exclusion for mechanical breakdown or electrical disturbance, without a detailed investigation. While these might be specific exclusions in some policies, they are typically intended to apply to internal malfunctions rather than external damage that occurs during transit. Broadly applying such exclusions without evidence of an internal breakdown would be a misinterpretation of the policy and a potential violation of claims handling regulations. The professional decision-making process for similar situations should involve a systematic approach. 1. Understand the policy. Thoroughly review the specific inland marine policy wording, paying close attention to definitions, ensuring agreements, and all exclusions. 2. Investigate the loss. Gather all available facts about the loss, including the cause, circumstances, and the nature of the damaged property. 3. Apply exclusions carefully. Determine if the cause of loss clearly falls within the scope of a specific, unambiguous exclusion. Consider the intent of the exclusion and how it relates to the type of property and coverage. 4. Consult resources. If there is ambiguity, consult internal claims guidelines, legal counsel, or relevant state insurance department bulletins. 5. Communicate clearly. Explain the coverage decision to the policyholder in writing, referencing the specific policy provisions and the reasons for the decision. Question 19. Operational review demonstrates that a builder's risk policy for a commercial building under construction has a stated limit equal to the total contract price for the completed project. The policy has been in effect for 3 months, and construction is approximately 20% complete. A significant fire has occurred, causing substantial damage to the partially constructed structure. Considering the principles of inland marine insurance and regulatory requirements for valuation, which approach to determining the payout for this loss is most appropriate and compliant? Option A. The payout should be based on a fixed percentage of the total contract price, as determined by the insurer's internal guidelines for construction progress. Option B. The payout should be based on the actual cash value of the work and materials expended to date, plus a proportionate amount of anticipated profit on the completed structure. Option C. The payout should be limited to the cost of materials that were damaged or destroyed, irrespective of labor costs or work performed. Option D. The payout should be the full stated limit of the policy, as this represents the agreed-upon value of the completed project. The correct answer is B. The payout should be based on the actual cash value of the work and materials expended to date, plus a proportionate amount of anticipated profit on the completed structure. Explanation. Scenario analysis. This scenario is professionally challenging because determining the correct valuation for a building under construction requires a nuanced understanding of both the policy terms and the evolving nature of the insured property. Insurers must balance the need to provide adequate coverage against the risk of overinsuring or underinsuring, which can lead to financial losses or disputes. The dynamic state of a construction project, with its fluctuating costs and progress, necessitates a valuation method that accurately reflects the actual value at the time of a loss, rather than a static estimate. Correct approach analysis. The correct approach is to value the building under construction based on its actual cash value at the time of loss, which typically includes the cost of materials and labor expended to date, plus a proportionate amount of anticipated profit on the completed structure. This approach is correct because it aligns with the fundamental principle of indemnity in insurance, aiming to restore the insured to their pre-loss financial position without allowing for profit from the loss itself. Regulatory frameworks for inland marine insurance, such as those governing builders' risk policies, generally mandate that coverage limits and payouts reflect the actual value of the property at the time of the covered event. This method ensures that the insurer is not liable for costs not yet incurred or for speculative profits, while still providing sufficient coverage for the work and materials already incorporated into the structure. Incorrect approaches analysis. Valuing the building solely based on the total contract price for the completed project is an incorrect approach. This method fails to account for the fact that at any given point before completion, the actual value of the construction is less than the total contract price. Insuring at the full contract price from the outset could lead to overinsurance, where the coverage limit exceeds the actual value of the property, potentially resulting in higher premiums for the insured and an increased risk of moral hazard. Valuing the building based only on the cost of materials purchased and delivered to the site, without considering labor costs or work performed, is also an incorrect approach. This method understates the actual value of the construction. The value of a building under construction includes not only the materials, but also the labor invested in assembling those materials and bringing the structure closer to completion. This would lead to underinsurance, leaving the insured with a significant financial gap if a loss occurs before completion. Valuing the building based on a predetermined fixed amount that does not adjust for the progress of construction is an incorrect approach. This static valuation fails to reflect the reality of a construction project, where value is added incrementally. If a loss occurs early in the construction phase, a fixed valuation might be excessive, and if it occurs later, it would be insufficient, thus violating the principle of indemnity and potentially contravening regulatory requirements for accurate valuation. Professional reasoning. Professionals should approach the valuation of buildings under construction by first thoroughly understanding the specific policy wording, particularly definitions of value and loss. They must then consider the stage of construction and the components of value that have been incurred: materials, labor, equipment, and a reasonable allocation of anticipated profit. This requires clear communication with the insured and potentially with the contractor to ascertain the actual progress and costs. When faced with a claim, the professional must apply the agreed-upon valuation method, ensuring it aligns with regulatory mandates for indemnity and fair claims handling. If there is ambiguity, seeking clarification from underwriting or legal counsel is a prudent step. Question 20. Comparative studies suggest that the valuation of contractors' equipment for inland marine insurance claims can be a point of contention. When assessing a claim for damaged equipment, which of the following valuation methods best aligns with the principle of indemnity and standard regulatory expectations for determining actual cash value, considering the equipment's age and condition at the time of loss? Option A. Valuing the equipment at its original purchase price, ignoring any depreciation. Option B. Valuing the equipment at its actual cash value, then deducting the estimated cost of all necessary repairs. Option C. Valuing the equipment at its actual cash value, accounting for depreciation due to age, wear and tear, and obsolescence, but not deducting for hypothetical future repairs. Option D. Valuing the equipment based on the manufacturer's suggested retail price for new equipment. Correct answer is C. Valuing the equipment at its actual cash value, accounting for depreciation due to age, wear and tear, and obsolescence, but not deducting for hypothetical future repairs. Explanation. This scenario is professionally challenging because accurately valuing contractors' equipment for inland marine insurance purposes requires a nuanced understanding of market realities, equipment condition, and the specific terms of the policy, all while adhering to regulatory guidelines. The insurer must balance providing adequate coverage for the insured with managing risk and preventing overinsurance. Careful judgment is required to ensure the valuation reflects the actual value of the equipment at the time of loss, preventing both underpayment to the insured and excessive claims payouts. The correct approach involves valuing the equipment at its actual cash value (ACV) at the time of loss, considering depreciation due to age, wear and tear, and obsolescence, but without deducting for hypothetical future repairs. This aligns with standard insurance principles and regulatory expectations for fair claims settlement. For example, under typical U.S. state insurance regulations, ACV is the prevailing standard for property losses unless a replacement cost policy is specifically purchased. This approach ensures the insured is compensated for the value of what they lost, reflecting its used condition, which is consistent with the premium paid for a policy based on ACV. An incorrect approach would be to value the equipment at its original purchase price without any depreciation. This fails to reflect the actual market value of used equipment and would lead to overinsurance, where the insured receives more than the equipment was worth at the time of loss. This is ethically problematic as it can incentivize fraudulent claims and is contrary to the principle of indemnity. Another incorrect approach is to deduct the cost of hypothetical future repairs from the ACV. This is also a failure of indemnity, as the insured is being penalized for the equipment's condition beyond normal wear and tear, and the policy is intended to cover the value of the equipment as it was, not as it could be after repairs. This can lead to underpayment and dissatisfaction for the insured. Finally, valuing the equipment based solely on a manufacturer's suggested retail price, MSRP, for new equipment is incorrect. MSRP often does not reflect the actual market value of used equipment, especially after significant depreciation. This approach would also lead to overinsurance and is not a sound basis for determining the actual cash value of the insured property. Professionals should use a decision-making framework that prioritizes understanding the policy's valuation terms, ACVS, replacement cost, researching current market values for comparable used equipment, assessing the physical condition of the specific equipment, and applying depreciation factors consistently and transparently. This process ensures compliance with regulatory mandates for fair claims handling and upholds ethical obligations to both the insured and the insurer.